Two computers in
Happy Friday, everyone. Did everybody go out and meet the firms today? Yeah, fantastic. Good work. It's the way to get extra credit in this class. It's also, well, a good way to promote your career, find job,
That's not the important part.
Yeah, the extra credit, that's the real thing. Yeah. I don't know. I feel a little bit out of sorts with everybody's dressed up. Chandler, you want to teach the class today? You look more like an accounting professor than I do. Yeah. Oh, wow. All right. I was relating the story to one of the recruiters who was a former student. It's like my first 6 years at Truman, I was like dressed very nicely and always wanted to make sure I had slacks and shoes and I wanted to make sure I looked presentable. By the time I got tenure, I was like, if they're going to fire me, they're going to fire me. So yeah. This is the best effort I'm giving you guys. It's not the quality. It doesn't reflect the quality of the teaching I will give you. It reflects the quality of my attire, my personal style, which is much worse, much worse. All right, so chapter 4, we got some homework we're going to go through. So one of my favorite cases of all time is actually part of chapter 4, which we're going to talk about. But before we do that, we've got to get through some multiple choice questions and some concept questions. So let's go ahead and do that. Question 414, the existence of audit risk is recognized by the statement of the auditor's standard report that the auditor what? So we talked about this, the origin of this concept, and we talked about it at the beginning of chapter 4, that audit risk exists by virtue of the fact that the auditor could do everything correctly within their power, but they could still fail to detect a material misstatement. And it alludes to the fact that the auditor cannot do every single possible task that they need to do before them. And remember, we talked about this back in chapter 1, and we said, what is the level of assurance that an auditor provides? And that's reasonable assurance. If we can contrast that to absolute assurance is not feasible. It's not possible. So reasonable assurance basically says we're going to do enough to what's reasonable to avoid material misstatements. But there is some risk present going to be no matter what. That's the idea behind audit risk. So when we think about the nature of audit risk, it's because the auditor obtains reasonable assurance about whether the financial statements are free of material misstatement. Now, reasonable assurance implies that there's a possibility that something could go wrong. That's just the nature of it. So that's going to be something we have to keep in mind. We'd like to avoid that to all possibility, but it's by nature or virtue of our discipline, that's going to be something that could happen. 415. Risk of material misstatement refers to the combination of which two components of the audit risk model? This one's easy. These are the questions that you strive for in auditing, because these are remembering and understanding questions. And those are the ones that are easy to answer. Like the last one was not just a remembering and understanding, but with an application. You had to say, all right, I remember the idea of reasonable assurance. How does that relate to the audit risk model? This one's easy. You just have to remember, what are the two components of risk of material misstatement? Inherent risk, control risk. Okay, remember it. Don't forget. Love it. All right. 416, as lower acceptable levels of both audit risk and materiality are established, the auditor should plan more work on individual accounts to do what? So this is kind of leading you to the answer to the question, what it is you're looking for. So when we talk about audit risk being lower, or we talk about materiality being lower, what is the concern that we have there? Well, why would we make materiality lower? Why would we make audit risk lower? And that's to ensure that we have details about more information. Now, if materiality is really large, or we set audit risk at its possibly maximum level, which is never going to be more than low, but we are a little bit more relaxed with it, it usually means that we care less about the nature of errors. The errors themselves can be larger and not significantly affect the nature of the audit. Somebody's having a lot of fun out there. I'm going to close the door. Not even sure what's going on there. It sounded like a celebration, which is usually the kind of amount of fun that we have in this class, I tell you. So as audit risk and materiality get smaller, we do that so that we can find smaller errors. That's the nature of it. So as the materiality and audit risk get smaller, the goal is that smaller errors become more pronounced and more significant relative to the audit of the whole. So we're trying to find those smaller errors. All right. 417, which of the following characteristics most likely would heighten its auditor's concern about the risk of intentional manipulation of financial statements? I love this question right here. These are the types of questions I shoot for on the exam. I don't always succeed, but I shoot for them, okay? So let's go ahead and think about this. When we're talking about intentional manipulation of financial statements, What is the things that we'd be concerned about that would drive that? And remember, we would consider this from the risk factors that we talked about on Wednesday. So 3 risk factors: pressure, opportunity, rationalization. Those are all things that we would be concerned about. So let's see how these would be affected. All right. Turnover of senior accounting personnel is low. Now, if turnover of senior accounting personnel is low, it means that the people who are in the place in a certain position, like people who are executives in the personnel in the organization that were there last year, are the same people who are there this year. Do we tend to see churn in corporate environments when fraud's going on? Do we tend to see higher turnover or lower turnover? Just intuitively speaking. Let's put it this way. If you really dislike your job, are you more likely to leave or are you more likely to stay? I'm a survivor, Dr. Barnes. I'm more likely to stay. Yeah. No, more likely to leave. We have pressures that are compounding upon you and committing fraud. That's going to be one of those things that are more likely to leave. So we would expect turnover of senior personnel to be high. Yes.
Is that still true in like small business? The control is more of a factor.
Well, so we would for senior personnel, it would be a little bit less of an issue because the senior personnel would likely be an insular group, but we could actually look at the organization as a whole. The people they hire probably don't stay there for a long time. An anecdotal piece of information: there was a company called Health South, which was one of the big collapses that occurred in the early 2000s. In a 5-year period of their fraud going on, anybody want to guess how many CFOs they had during that period? 5. CFO for every year. Okay, they were committing that financial statement fraud. So that's kind of anecdotal proof of that particular statement. Insiders recently purchased additional shares of entity stock. So if a fraud is going on and you're an insider, are you going to be prone to say, you know what, the value is only going to go up from here? You're going to be kind of like, this place is going to crash really quickly. I'm selling all my shares, okay? Buying shares means you think the company is going to continue to be more successful. It's not likely there's a fraud going on. Management places substantial emphasis on meeting earnings expectations. That sounds like a pressure to me. Okay, if management is very, very concerned about making sure that we meet certain guidelines, that's going to put pressure on the rest of the organization to meet those goals. Pressures can be one of those factors that leads to fraud. So C is probably our answer, but let's go to D. The rate of change in the entities industry is low or slow. Okay, slow. So is that going to be more risk or less risk to the organization if the rate of change in the entities industry is slow? Less risk. That's one of those business risks that we concerned ourselves with, and that's going to be a lower inherent risk or lower business risk. Yes, sir.
I read B. I kind of got confused because like I thought they meant like this statement like to push the stock price up.
So the key word is there is insiders would be. So insiders are going to be people within the organization who are going to say, I have information about how the organization is going to perform, so I am either going to buy or sell my shares. And so that's long been an indicator of fraud. In fact, it's fairly well-known personality. I don't know what she's doing now, but you probably heard Martha Stewart. One of the reasons she went to prison is because she got insider information on how her shares were about to collapse because of a big fraud that was in the organization. Can't remember the name of the company, but the people who found out about it were not happy. And as a result, now Martha Stewart's a convicted felon. So that's probably not what was her career path was planned on. So. All right. What do we got? 418. Which of the following is a misappropriation of assets? What do we call misappropriation assets? What's the vernacular for that? Theft. So we're looking for something being stolen. All right. So classifying inventory held as resale or as supplies. Be careful when you see the word inventory. It's very natural to say if we're talking about inventory, then it must be theft. Is this a theft of inventory? No, this is a misrepresentation of inventory amounts. All right. What about investing cash and earning was 3% interest rate as opposed to paying off a loan with an interest rate of 7%? That's probably not good business practice. I don't know if that's even fraud. An employee of a consumer electronics store steals 12 CD players. Is there a lot of stealing involved in theft? Tends to be, yeah, tends to be. So we're going to say that's probably our answer. Okay. All right. 20. I'm trying to do this without my glasses on because I want to look cool, but I'm done with that. All right. All right. Which of the following is an example of fraudulent financial reporting? So this is the opposite of theft. This is where we misrepresent information in the financials. So we're looking at the opposite. Company management falsifies the inventory count, thereby overstating inventory and understating the cost of sales. So we see inventory again. Is this inventory situation referring to theft? No, it's misrepresenting the value of the inventory. So that's probably our answer, but let's just go ahead and look at the other answers for context. An employee diverts customer payments to his personal use. We could basically rephrase that as employee steals customer payments. That sounds like theft. An employee steals inventory, enough said. An employee borrows small tools from the company and neglects to return them. The cost is reported as a miscellaneous operating expense. So just as good business use, if you borrow something from your employer and neglect to return it, what do we call that? That's theft. Okay. All right. So your intentions may be good, but please don't neglect to return something if you borrow from your employer. In fact, make sure you get permission before you borrow anything. All right. Don't want people coming up to my offices. I'm just going to borrow the grade book for Dr. Barnes's class. That would be awkward. Which of the following is correct concerning required auditor communications about fraud? All right. So what do we say about communications about fraud? We said that generally when a fraud occurs, that it's going to be reported to the next level of management. And if we're talking about senior levels of management, or if we're talking about fraud that is material in nature, it gets reported to who? The audit committee. So fraud that involves senior management should be reported directly to the auditor by the audit committee, regardless of the amount involved. So keep in mind this statement is a little bit distracting from what we said. So if it involves senior management, the materiality scope is irrelevant. We're still going to report to audit committee. We are also going to report any fraud, regardless of the level, to the audit committee if it's material in nature. So those are two criteria that we need to separate out. In this case, it's talking about the former, where the fraud is not material in scope, but it's something that was committed by senior management. So audit committee does need to know about that. Okay. Yes.
Before we go to the other ones, we need to go back to 415.
415, absolutely. So risk of material misstatement refers to a combination of which two components of the audit risk model?
I thought that it was control risk and detection risk.
So
aren't you detecting the misstatement, material misstatement?
So detection risk is basically talking about the auditor's procedures and the likelihood that they will detect a misstatement that has occurred. The risk of material misstatement, remember, we separated those out. We say this is the risk that by the nature of the client's operations and controls that a misstatement exists in the financial statements. And we evaluate risk of material misstatement. We say based on that, that's how we set detection risk. So yeah, it's a good question though. It's important to make sure you understand the distinction because that's an important delineation to make. All right, moving on to problem 428. All right, for each of the following situations, explain how the risk of material misstatement should be assessed and what the effect of this assessment will have on detection risk. Now, here's how you need to approach this particular question. Risk of material misstatement contains two components, inherent risk and control risk. So you need to evaluate both of those. You can't just say risk of material misstatement is high and move on with your life. I mean, if you did, I can't stop you from doing that. But what you would want to do in answering this question is you'd want to think, what is inherent risk? What is control risk? How do I determine that? In some of these situations, one or more of these may not be immediately obvious. I should say one of these should not be immediately obvious, but we can make our best guess. So let's go ahead and talk through this. All right, Johnson Incorporated is a fast-growing trucking company operating in the southeastern part of the United States. The company is publicly held, but Ivan Johnson and his sons control 55% of the stock. Ivan Johnson is the chairman of the board and the CEO. He personally makes all major decisions with little consultation of the board of directors. Most of the directors, however, are either members of the Johnson family or longstanding friends. The board basically rubber stamps Ivan Johnson's decisions. All right. Now, there's a little piece of information here that gives us light to the inherent risk of the organization. What is that piece of information? So remember, inherent risk of the organization is the entity and its environment, okay? This is before any consideration of controls or the control environment that's in place in the organization. That first sentence says that it's a fast-growing trucking company. So it implies that there's an industry where there is going to be at least some risk. Now, that's admittedly very little information, but we can kind of probably say that if it's fast-growing, that they're going to be growing in the industry and their business is going to be subject to increasing risks over time. Now, that's not a lot, but let's just go ahead and say right now, inherent risk is probably high. What the nature of this particular question is more about the control risk. Now, if you're an auditor walking into this particular client, what is going to be your impression of control risk for this client? Yeah, you're going to be like, this is a nightmare. This is what I dream about at night. And if you're not dreaming about that at night, I've not trained you well enough. Okay. This is really, really chaotic. So we've got a control environment where one person is basically making all the decisions. There's no oversight. There appears to be no review. Basically, the person makes that decision. And everybody says, go for it. Okay. Says, I'm going to take all the money in the world and put it in my pockets. It's like, yes, you do that. Okay. That's something you're entitled to because you're the chairman of the board and you're the CEO. So Controls here, I would say the control risks are very, very high. Now, if we look at the organization and we said, look, this organization is not subject to many risks, we could set inherent risk at medium or even low. That would be a different story. But overall, I would say, in all likelihood, risk and material misstatement is going to be pretty high for this particular company, just by virtue of the fact that we think inherent risk is high, and control risk is absolutely 100% definitely very high. Okay. MaxiWrite Corporation is one of several companies engaged in the manufacture of high-speed, high-capacity data storage devices. The industry is very competitive and subject to quick changes in technology. MaxiWrite's operating results place the company in the second quartile in terms of profitability and financial position. The company is not a leader in the industry, and its products lack the performance levels of the industry leader. All right, this is kind of the opposite scenario. What do you guys think about inherent risk with this organization right here? It's okay, Dr. Barnes. I don't mind. It's all good. It's all good. I'd be paranoid if I was working for this company. I said, this company could be to disappear next quarter. They are not the leader in the industry, and the industry is highly competitive and subject to change, okay, subject to quick changes. And they tend to be behind in terms of changes. They don't keep up with the rest of the industry. Do you want to work for a business like that? If I say, I'm going to give you a job right now, you can go work for this company, you'd be like, Dr. Barnes, that's great, but I don't know if I'm going to have a job like next month, okay? This is high inherent risk, very high inherent risk. So risk and material misstatement is high, right? Not so fast, not so fast. Okay, I told you I had to think about this. What do we know about controls? What do we characterize controls as? Response to a risk. Do we know risks exist in this organization? Okay. Could they effectively implement controls that respond to these risks? So let's think of two scenarios. Let's say that they've got a really good management group, and the management group is doing their best to make the organization work, but it's just really, really hard to grow in such a competitive industry. So they've implemented a lot of controls to make sure that this business will continue on for the foreseeable future. And all these risks are effectively addressed, and you as the auditor say, wow, they're doing a really good job with their controls. What would you say risk and material misstatement is in that situation? I'd say probably if they're really good controls, I'd say low. Because remember, risk and material misstatement is driven by whatever our lowest level of risk is. And if they've got great controls, it doesn't matter what their inherent risk is. They've addressed all of their risks. Change the question. They've got really high inherent risk, and management's kind of like, you know what? I'm probably going to be looking for a job next year anyway, so I don't care. I'm giving up on controls for this company. So what do we say control risk would be in that situation? High, okay. Inherent risk is high, control risk is high, risk and material misstatement is? It's high, okay. You're starting to confuse me, yeah. So it's high. Risk and material misstatement is high, so we are going to say, look, this company is a mess. We're going to have to do a lot of testing to make sure that the information in the financial statements is correct. All right. First National Bank of Ponce City has been your client for the past 2 years. During that period, you've had numerous arguments with the president and controller over a number of accounting issues. The major issue is related to the bank's reserve for loan losses and the value of collateral. Your prior audits have indicated that a significant adjustment is required each year to the loan loss reserves. Okay, so this one's kind of interesting because there's not any direct information about inherent risk or controls, but we can determine a lot based on the nature of this particular scenario. So let's talk about inherent risk. The fact that they're having this kind of operations in this business, they have this volatility, probably implies that this is a high risk industry. This is an industry where the businesses are subject to risk. So we can probably infer that. Now, it's not a good implication. We would like more detail, but for right now, we're probably going to say high. Now, the information, let's talk about control risk. The information in this particular scenario says that they have had to make adjustments in the past years, okay? Prior audits indicated the significant adjustment is required each year to the loan loss reserves, meaning that in the past 2 years, each of the past 2 years, they have had material misstatements. What are controls designed to do with respect to financial reporting? Yeah, they're trying to make it more accurate. They're trying to prevent material misstatements from occurring. Did the controls work in prior periods? They did not, because they wouldn't have to make an adjustment if the controls worked. So the controls, by the definition in this situation, are probably pretty awful. Therefore, control risk is probably high. So if we assume inherent risk is high and control risk is high, then risk and material misstatement is going to be? There we go. All right. All right. Risk and material misstatement is going to be high, and therefore we're going to say we got a lot of work ahead of us. By the way, is this the kind of client that you would want to be on if you're an auditor? No, this is a contentious client where you'd probably say, look, the frustration and agony that you put me through is not worth my time. See ya. Okay. That's basically where you'd be on that. Discussion case 433, Costs Corporation. Hopefully you read through this. One of the things about these cases, we're going to talk about a few of these cases. There's going to be this one, which we're going to see again, by the way. We're going to have it as a discussion case for Chapter 6. But we're also going to have another one about Dixon County, Illinois. There is a lot of information online about both of these cases, and it's fascinating, okay? So some of the detail I want to kind of give you, this was actually occurring right as I was starting my PhD program at Oklahoma State. All this information was coming out, and it was just, there were so many media sources that were on top of this. Just for context, this Cost Corporation fraud was occurring over a period, I believe it was about a 7-year period as they were talking about. So this says that she stole $34 million over this period and the 7-year period. Take a guess at what their operating income was for that, or their, sorry, not operating, their net income was for that same 7-year period. So aggregate income, this publicly traded company, their aggregate net income for 7-year period was $70 million. She stole half of net income over that 7-year period. And this is not a financial statement fraud. This is not fraudulent financial representation. This is actual theft. She stole from the company, which is why it's so fascinating, because you hear about amounts this large and you think, well, it's got to be a fraudulent financial reporting scheme. It's not. She actually was stealing from this company. It talks a little bit about the nature of it. Excuse me. So yeah, pretty amazing. So let's go ahead and read through some of the details on this, and we're going to talk about this. Now, we're only going to scratch the surface on this, but I want to get you thinking about this because there's a lot to talk about. So Sagdeva used the embezzled funds to sustain a lavish lifestyle, including purchasing a vacation ownership in Hawaii, a Mercedes-Benz, and other automobiles. She also used the proceeds to pay for luxury travel and numerous personal items, including luxury clothing, furs, designer shoes, jewelry, and art. One neighbor stated that packages delivered to her front porch would sometimes reach 6 feet high. I love the exclamation mark there. Sagdeva also maintained a large household staff, such purposes well beyond her cost salary, which was a pretty good salary, $175,000. That being said, if you're earning 6 figures, that does not automatically mean that you can live like the Brady Bunch and have your own live-in housekeeper. So yeah, she explained the lifestyle by stating her husband earned a couple of $1 million a year, and they both came from wealthy families. Well, that's convenient. That's convenient. So some interesting stories behind this. When they were in trial, one of the arguments first of all, she would go on massive shopping sprees on weekends, and these were not shopping sprees at a local mall. She would actually travel to other cities in the country, and she would charge the trip to the company, and then charge all of the shopping sprees to costs. And you can read about how she did it, because they talked about how they did the cash transfers of the wires, and they actually said SFA Incorporated and for Saks Fifth Avenue and NM Inc. for Neiman Marcus to try to disguise the fact that she was shopping. The interesting part is that she was not buying these things for herself. Obviously, she was buying a whole lot of stuff, but especially for the clothing, she would go into work the following week after she'd gone on these shopping sprees, and she would sell the clothing to her coworkers. She would like saying, well, this is something that I really liked, but I don't think I'm going to wear it. Here, would you like to buy this? And they'd buy it from her at a discount. So you kind of think she was double dipping, because Cost was paying for the clothing itself, and then she was actually selling it off, which sounds like a mafia scheme right there, to be honest. Now, interestingly, and I don't want to make light of mental illness because I do think it's a very serious issue, but one of the defenses that they made in her case was that these shopping sprees were how she was coping with her bipolar disorder. And so I will say that, again, not making light of it, but there are definitely better ways to deal with mental illness than committing fraud. So just remember that. All right. Massive misappropriation ultimately discovered when American Express, not the auditors, notified the company the funds were being wired from the company bank account to pay for expenses on Sagdeva's personal credit card. According to the SEC, Sagdeva authorized at least 206 wire transfers of funds from Cost bank accounts to pay for American Express credit cards, bills, and issued more than 500 cashier's checks from company accounts to pay for her personal expenses. Sagdeva used cashier's checks to make direct payments to retailers such as Neiman Marcus, Saks Fifth Avenue, attempted to conceal the identities using the initials. Also attempted to conceal a fraud by using other Cost employees to make numerous fraudulent entries in Cost's book and records. Julie Mulvaney, the company's senior accountant, was also responsible for making journal entries, reconciling accounts receivable, reconciling the company's bank statements, ordering cashier's checks, promote processing wire transfers, and checking the daily account balances, and assisted Sagdeva in covering up the fraud. Now, this is interesting because we're going to talk about something really, really important here in just a second. But She did have accomplices in here, and the relationship of Julie Mulvaney and Sue Sack-David was kind of interesting because I think Mulvaney was just basically trying to be a good person and say, I really like Sue. I don't want her to see her go to jail. I'm going to do this one time. And then she did it another 205 times after that. Okay. So I don't know that she was willingly complicit, but it just kind of, that's how it always read to me in that situation. That being said, it's very hard to uncover a fraud when you have willing accomplices. But what's more challenging, what's more more of an issue is what we're about to read in the next second, because we're going to talk about Michael Koss. And Michael Koss is somebody. He's definitely somebody. So Michael Koss simultaneously held 5 senior management positions: vice chairman, chief executive, chief operating officer, president, and chief financial officer. Wow, this guy must be a financial genius. Koss had little or no educational background experience in the areas of accounting or finance. Okay, all right. So yeah, not a financial genius, just somebody who did not want to pay salaries to necessary positions in the organization. Gotcha, I gotcha. He allegedly delegated important responsibilities typically performed by the CFO and Sack-David on a regular basis. So we talked about this in AIS and this various responsibility, a concept that we're going to revisit again. So Michael Koss has one area of responsibilities and Sue Sack-David has another. But basically, Michael's like, you know what? I'm going to the golf course. I'm not going to authorize your wire transfers. You just authorize them yourself. So she was both authorizing wire transfers, recording the wire transfers, and she had custody of the assets associated with that. We talked about that. Custody, authorization, recording. What is that called? Cars, segregation of duties. Yes. Yeah, that's gonna be something that reflects upon it. If those three areas are violated, if somebody holds the same responsibility area, fraud is very likely to occur, especially failures in controls. They did not have an internal audit function. Control environment appears to have been remarkably relaxed, and its corporate board rarely changed, excluding a member added in 2006 and founder John Koss. The board members had an average tenure of 27 years. Now, admittedly, this is an older case. This took place in the 2000 aughts. Okay, so like 2003 to 2000 or 2002 to 2009 was when the fraud was taking place. That being said, can we say that corporate form changes pretty significantly over a 27-year period? Are the risks that an organization is subject to, say in the 1980s, the same as the organization was subject to in the 2000s? No. We can kind of see that change over time. It's even just really, really short changes in time. Technological obsolescence is a really, really big one, but kind of knowledge is a really, really important one too. Who's going to be more knowledgeable about what the current state of technology environments? A new college graduate or somebody who served on a board for 20 years and has not actually done any work in that period of time? Probably the new college graduate's going to have a little bit more knowledge in that area. So having fresh blood on the board would probably be very insightful for being able to identify risks in this nature. Because of a small company, Koss was not subject to the section of the Sarbanes-Oxley Act that requires outside auditors to evaluate companies' internal controls or financial reporting. Make a note of that because we're going to talk about that in Chapter 6, and it's really important. Most public companies are required to have test of controls. Koss was not. And so that may have been a reason why some of these issues were left unchecked. During the embezzlement, Koss's audit fee was reduced by half from 114 to 2007 to 63,600 in 2008. Now, this sounds like a big risk factor, but this actually was pretty common around that time. Something massive was occurring in the world from 2007 to 2008. That was the subprime mortgage crisis. And having actually worked in public accounting during that time, this was actually pretty common for companies to say, did not have nearly as much business. We cannot pay nearly as high audit fees. That being said, how effective do you think the work of the auditor would be if you cut their fees in half? Do you think that they're going to do the same quality of work? They're probably going to say, look, you're paying us half as much work or half as much money. We're going to do half as much work. And so that's kind of a problem there. And they co-chaired the fundraising gala for Big Brothers Big Sisters with cost outside auditors. All right. So let's answer the second question first, because this should be an obvious one. Is it appropriate for one individual to hold 5 significant senior manager positions all at the same time in a publicly traded company? Okay, I see one person nodding their head. I'm going to throw something at you. Okay. All right. No, it's obviously not appropriate. Now, first of all, the intuitive answer is going to be not. There's a reason why these are separate positions, but practically speaking, we need to understand that these are different roles that are being established, and these different roles serve functions within the organization. And there's a reason I brought up segregation of duties is because oftentimes these roles do need to be separated out. Now, we're going to revisit this to a major degree when we get to Chapter 6. You're going to be so sick of me talking about CAR that you're going to be like, I'm never going to forget segregation of duties again. And that's a good thing, okay? But we're going to revisit this particular example. If those responsibility areas are not separated out, then it's just very, very easy for misstatements to occur. But assume that you're a member of the audit team. Identify the fraud risk factors for misappropriation of assets that were present at Cost Corporation. All right. So fraud risk factors, we got three of them, the fraud triangle. We've got opportunity pressure, opportunity rationalization. Let's deal with pressure, okay? Because pressure is not really terribly obvious, but there are some factors that are important here. So what pressures can you identify that would cause Susak David to commit this fraud? Her lifestyle, yeah. She was just kind of like, I like being rich. I like being able to spend all that money. Okay. Any others? I think we can probably argue that her mental state of what being is probably a pressure. Okay. And again, I'm not disparaging that. I'm mostly just trying to identify what would be a factor. So yeah, we can identify some incentives that are very, very present there. All right. What about the opportunities? Were there opportunities? Opportunities abound. Now, we just talked about this in one area. What's probably the biggest opportunity that we can identify here?
Cost.
Yeah, cost, basically holding all the senior positions and saying, Sue, can you do my work? Okay. Now let's remember that because that may be relevant here in just a second as well. Okay. But opportunities like saying, oh, segregation of duties has been established. No, it's not. You know, Sue has all the power and she can do whatever she wants. Are there any other opportunities that were present here? I mean, there are, but that was obviously the big one. But what are some other ones that we can identify in this scenario?
It didn't have an internal audit function.
No internal audit function. We don't have anybody inside who's going to be experts in this area to say, yeah, we need to improve this. We need to fix this. People who actually are experts in these areas to actually know how to implement proper controls and segregation of duties. What else?
They weren't subject to SOX.
They weren't subject to SOX. Yeah, they didn't have to do certain types of reporting under SOX, even though they're a publicly traded company. Good. Anything else? Could probably say the audit fees reduction was probably an issue because they had a reduction in the audit work. Now it's only for 1 year, so that's a really loose. But that actually was the time period when the greatest fraud occurred. By the way, something that you will see in frauds of this nature is they tend to start out very, very small and get gradually bigger until at some point they're outrageous. Susak David did not say, okay, $34 million, I've got 7 years, I'm going to try for $5 million a year. That's not the way that worked. Her first frauds were probably very, very small, or I shouldn't say probably, I know they were, okay, for a few $1,000s, and nobody was noticing. And then eventually she started getting bigger and more grandiose until she was spending millions of dollars on an excursion. So that's kind of what we see with the escalation of fraud. And it's very fascinating from a fraudster's mindset because early on they're very suspicious and very cautious, but once they realize that nobody's paying attention to them, that's when it's just kind of like, I can do whatever I want. So that's kind of an interesting one, is that this one probably would have been detected a lot sooner had there been more audit oversight during this year. But these are the years that she was committing the largest amounts of her fraud. What about the board? Can we say the corporate board is certainly problematic? Yeah. It's very easy to get away with things when the board doesn't know what's going on. That's one of the reasons why we have such strict protocols on the composition of the audit committee with respect to financial statement audits under the PCAOB and Sarbanes-Oxley. So we want to make sure that if something is happening, that at least one group will be able to say, look, we need to review that and make sure that's okay. It's interesting. In this class, I used to actually have my students read a book. It's called Bad Blood. It was the story of Theranos. Has anybody heard of Theranos? So if you have never heard of Theranos, it's not really an audit related story. It's more of just kind of a weird control corporate environments. But this is a blood testing company, started out by Elizabeth Holmes. She was basically trying to patent this mobile device that she said was going to change the blood testing industry. The problem was it never worked. She could not actually get any of her prototypes to work. And one of the reasons the company was in existence for about, I think, 15 years. And at one point was valued at like $9 billion. The reason that she was able to get away with it is because she had such a powerful corporate board. She had a lot of dignitaries, like former secretaries of state, people who were retired military generals. At not any point to the people on the corporate board were people who knew anything about medical testing or about the operations of the medical industry, which is kind of interesting. It's an insight into something like this. All right, last topic for the day. Now, I apologize. It occurs to me that in the assignment instructions, I told you guys to do the risk assessment, and we're still going to talk about that. But a little bit of context. Usually in the past, I had my students directed to certain areas that were provided additional information. In fact, for previous editions of this book, the editors, publishers, they actually had a website for both Willis and Adams and Earthwork Clothiers that I directed my students to watch. Well, starting with the 12th edition, they stopped supporting the websites. So I just basically had my students read the earthware background. I realized that not all the information that you needed to answer these questions is present in the background. I have changed the parameters of the assignment. You're not responsible for the parameters of the assignment. The only reason I did that is because when I copy this course for next semester, I want to make sure that I made the proper adjustments. But we are going to look at both the earthware background and we're going to look at some information from the textbook, which is there's actually an annual report for the previous year in the textbook, a sample annual report, which if you caught that and you picked that up, then you found some of this information in there. If you didn't, no big deal. Okay, I didn't tell you to look at that, which I should have, and we'll have moving forward. Progress is really important. Okay. So basically what you had to go through here is I had a series of questions for you, and I want you to provide some descriptions of information and identify if there's risks present. Now, my history has been that audit students tend to be very, very skittish about this. And anything time you say, is there a risk present? The answer is always yes, okay? And that's fundamentally correct. You can still identify a risk in pretty many situations. But when we talk about this, we're talking about a significant risk that we need to be aware of. So what I'm going to do is I'm going to kind of go over these lightly, and then I'm going to stop on the ones that I think are the most prominent and important, okay? So we know that major sources of revenue, including the nature of products and its services. So this is basically a phone or mail order company that does retail services, which I would say that there's probably a risk with the nature of its operations. But again, we've already talked about the reason for that. This is a little bit of an older version of a company that probably doesn't exist in the same form in the current day and age. That being said, ignoring that, we know it, understand it. It seems to be a pretty stable source of revenue. So this is not particularly going to be a major risk area. Then about the entity's key customers, there's some information about there. If you go into the annual report, it actually talks a little bit about that. I'm not going to stop on that particular area. There's one area that I wanted to. So it talks a little bit about the nature of the operations here. And this is actually right after chapter 1 in the textbook, if you're curious about where I'm coming up with this information. Trying to make sure that I find, oh, wait a minute, maybe it's up there. Yeah, okay, I'll come back to that. So if you look in that area right there in the book, it says it has about 21.5 million customers on the mailing list and 7 million were reviewed as current customers. They purchased from the company in the past 24 months. They do have demographic information, and they say it's a pretty stable demographic. So even though it's a competitive industry, they do have a pretty stable set of customers, and they haven't had a large fluctuation in revenues over the past year. If anything, the revenues have increased from previous periods. So first two, I'm going to say not really any risks that we need to be worried about. But then it says, who are the entity's key suppliers? This is one that if you did not actually look at the annual report, you wouldn't be able to answer as effectively because it's not in the background. But let's go ahead and take a look at that so we can come up with an answer. So it deals directly with suppliers and seeks to avoid intermediaries. Now, this is important to note, okay, because this is going to create some concern with one of the statements that's about to be made. Produced by independent manufacturers with exception of soft luggage, which is assembled at the company's facilities. Company purchased merchandise from approximately 300 domestic and foreign manufacturers. Now, that's a pretty diverse supply chain. That's a good thing, all right? That means that there's some redundancy in its operations. However, one manufacturer and one intermediary accounted for 14 and 29% of the company's received merchandise, respectively, in 2021. So that's kind of interesting because that basically means that roughly 40% of their merchandise is accounted for by two quote unquote suppliers. I know they say one's a supplier and one's an intermediary, one manufacturer, one intermediary. What happens if one or both of those suppliers get disruption in their supply operations? Is that a risk to the organization? Yes, that is a pretty significant risk in the organization. And because they avoid intermediaries mostly, then they probably do not have a redundant setup to deal with that particular scenario. So if they lose a manufacturer, they don't have another manufacturer ready and willing to replace that manufacturer with respect to their operations. Also, in 2021, about 80% of the company's merchandise was imported, mainly from Asia, Central America, Mexico, and Central America again. They had that typo in there for like 5 years. Sorry. I don't know what happens. The company will continue to take advantage of worldwide sourcing without sacrificing customer service or quality standards. And that's an interesting thought. Is it within their purview to say that they can actually not sacrifice customer standards by importing internationally? In other words, what I'm asking is, are there other factors that we have to take into account that might create risks with international importing? Yes.
Currency risk.
Currency risks, good. So embargoes, tariffs, things along those lines, things that actually affect the cost of providing the merchandise. That's something we have to be very, very aware of as auditors, is that yes, they've got stable supply chains now, but that's subject to factors that could change in the future. That is not saying that we say, okay, we can't audit this company anymore. There's too much risk there. That is saying that we need to be aware that this is a significant risk area because this is the core of their operations. So this is an area where I'd be kind of like, yes, I need to detail about what concerns I have and what my general approaches would be. All right, I want to move a little bit forward because let's see. Let's talk about actually real quick. So what are the entity's major assets? There's not a whole lot to go onto there. Mostly the facilities, like the warehouse holding facilities, as well as their inventory. I think you probably make an argument that those are kind of the two primary assets that are going to be placed in the organization. So inventory, property, plant, equipment. And are there anything that would count as quote unquote an asset that's not really a balance sheet asset? So is there information concerns? I guess that's something we have to concern ourselves with. So they've got information about customers' names, addresses, telephone numbers, credit card numbers. That's not an asset in the traditional sense, but is that something that they need to treat with security like an asset? Like if they basically do not have strong protocols to protect that information, could they be subject to litigation in the future? Yes, particularly if there's a data breach. Not that data breaches ever happen. Oh, okay. They happen quite frequently, actually. So yeah, it seems like every other week I'm just kind of like, yeah, something else that I was on got a data breach. That's par for the course. Okay. So yeah, even though that's not considered to be a quote unquote balance sheet asset, it is still an asset that they maintain. So information is something we also have to concern ourselves with. So even though I wouldn't say that's a high risk area, that's something that would need to be considered with respect to the assets. What about the liabilities? Well, if you look at the financial statements, they don't have any long-term debt, but they do have a line of credit. And so that's actually pretty good. No long-term debt. So for those of you familiar with finance, is that a good thing or a bad thing? From tax perspective, you may say, well, it's a bad thing, Dr. Barnes. They can't actually take deductions on their tax return for their interest payments. But generally, do we view from a financial perspective, lower debt being a good thing or a bad thing? Good thing. Yeah, it tends to be a very good thing. So that's good to know. All right. Uh, Competitive industry environment, does that present any risks? What do you guys think? When you hear the word competitive, does that seem to imply risk? Yes, I would say that's a very big risk. And we know that the risk is present. We could even go down the rabbit hole. We could say traditional chains like companies like LL are going to be direct competitors. Or there's indirect competitors like other retail companies that are establishing online presences that are much easier and have lower opportunity costs in acquiring merchandise. So that's something I want to be aware of. This is one of those ones that it's always really challenging for me to work through the risks because I would not personally invest in a company like EWC if they existed. So like you still do telephone operations. Nobody uses telephones anymore. When's the last time you actually made a call on your phone? Has anybody made a call on their phone within the last 24 hours? Oh, goodness gracious. All right, so that illustration failed horribly. Okay, that illustration failed horribly. All right, I don't think I've actually had a phone call, and like I don't have to go back. I definitely have people call me, but I haven't had to talk to anybody on the phone. That's the way I like it. All right. Do customer dynamics present any risks? Not really. The customers are pretty stable. Technology factors, do they present any risks? I would say that there's an argument for yes and no here. It's obviously an area of expanding technology where we're very uncertain, but for the most part, they appear to have that in check. There is one more that we need to talk about, though. All the way down to number 40. Is high turnover of senior management, council, or board members? So the answer to this one is no, there's not high turnover. But then I want to note, are there any significant risks in this area that we need to be present or aware of? And this one was relevant to the earthware background. What did we know about the management? What happened in the controller position?
Got filled with an unqualified person.
Yeah, so Brad Norton left, said see ya, no real explanation for why, and then they hired Carol McKay, and Carol, meaning well, is just not qualified for doing it. It brought somebody in who's not got the appropriate work experience to be able to do the work, and both the auditors and the firm management has said, we're concerned that she may not be able to do the type of work that we need for her to do. Now, if you're an audit firm and you basically have made that statement, obviously it's great to agree with the client, but if you made that statement and said, okay, there's a risk here that needs to be wholly addressed, is that something that's going to cause you concern? Now, does that mean, again, I'm not asking you here, do we need to leave the client? Do we need to start storming for the door and saying this is too much risk? What am I saying in the scenario? I'm saying that this is a risk that has been identified that does not appear to be fully adequately addressed right now. That needs to be something that we're concerned about within our testing when we move forward. Have they taken substantial steps to address any particular potential problems that could come up with respect to this risk that still exists? So some of the risk has been addressed. There's not a real problem with executive personnel turnover, but with one particular executive, there's a propensity for misstatement just by virtue of the fact that this person is not experienced and does not have the necessary qualifications. Yes.
So in that scenario, would you advise the client to like preemptively replace her? Because you have to prove that you can't do it. It's just assumed that you can't based on it.
In that scenario, what I would argue is ultimately what we're trying to concern ourselves with is the integrity of the financial statement reporting system and the integrity of the financial statements themselves. So even though we have a concern about her performance, what would want to do is first in this first part of the audit, we wanted to determine, are our concerns founded, and if so, we would make a recommendation afterwards saying, look, this person is not appropriate for this position. We recommend that you feel somebody more appropriate for that position. But as far as how it would affect our audit moving forward, this is an unknown quantity. So we have to answer that question as part of the audit. It's a little bit like the little old lady scenario, the little old lady analogy I talked about on Wednesday, when you say, all right, this little old lady, she means well, but she doesn't understand new technology. She can't adapt to the changing business environment. And while we really appreciate all the candy that she's given us over the course of the audit, she can't stay in that position. We need somebody who's actually qualified to do the work. That would be kind of the same scenario that we'd be doing here.
So you'd be like more of a time frame.
Yeah, exactly. All right. And with that, I think we're done for another Friday. We'll be back on Monday. By the way, we start chapter 5 on Monday. Chapter 5 is the most important chapter in this entire course. Make sure you've got your listening ears on, so to speak. I'll see you then.
Right, so that's